All right, everybody, I'm Logan Alec. I'm a CPA, and in this video, I want to talk to those of you for whom it's been a little while since you last filed a tax return. Or maybe you filed your recent tax returns, but there were a few years ago, maybe 5 years ago, that you didn't file a tax return, right? Whatever. And either you want to file those returns now, or possibly the IRS is coming after you for those returns, or you're owed a refund for a previous year and you want to file that return so you can get your refund. Whatever the case is, I'm talking to you. And in this video, I'm going to be talking about the consequences of not filing your tax returns, how the IRS treats individuals who do not file tax returns, and then finally at the end of the video, I'm going to get practical. How do you do this? What years should you file first? Should you not file certain years? What if you don't have the information for some years? How can you gather or at least estimate that information to reconstruct your tax records? How should you submit these returns? All those questions, I'm going to get into them in this video. But first, let's talk about why people don't file tax returns. Why do people get behind on their tax return filing obligations? Well, as a CPA, I've seen it all, but the most common reasons why people get behind is they didn't think they had to file, right? A lot of times these are either younger adults or older adults, right? Young adult, let's say they live at home with mom and dad. They think, oh, I live at home. I have a little part-time job. I don't have to file, right? Or maybe it's an older, recently retired taxpayer. They think, oh, because I'm retired now from the workforce, I don't have to file income taxes anymore. And that could be the case for some people, but not everybody. It really depends on your situation. Others, right? They know they're owed a refund, so they put it off. They think, oh, IRS won't care if I don't file because I'm owed a refund anyway. Or you have the opposite people, right? These folks, they start preparing the tax return and they see, oh, shoot, I owe a lot of money. So they choose not to file in a mistaken belief that it will help their situation. But probably the most common reason I see that people don't file their tax returns is that simply life happens. Oftentimes you go through a traumatic experience, be it a divorce or the loss of a loved one, natural disaster, loss of a job, you name it. So many life situations that life throws at us. They don't file one return and then it snowballs, right? Because I find that once somebody falls off the wagon once, so to speak, with one tax season, the next tax season rolls around, they just feel overwhelmed. Right? Like, oh, I didn't file last year and now I have to file both last year and this year, and it just feels overwhelming. So they try to stay off the IRS's radar, which they're rarely successful at doing that. And then one day they get the letter from the IRS, maybe a CP 59 or some other CP. It says, hey, you didn't file a tax return for such and such year. And then they ignore it. And then time goes by. IRS might send them a CP 515, then a CP 516. The CP 516 has stronger language. Instead of just, hey, you didn't file a tax return, it says you must file your tax return and you need to do so immediately. Finally, the IRS might send them the CP 518, which is their final reminder notice that the IRS has not received their tax return. And the taxpayer needs to file it, or the IRS may determine their tax for them and charge penalties and interest, right, which will continue to accrue. Later in this video, I'll talk about what this looks like when the IRS determines your tax for you. It's usually not pretty. Oftentimes, the client or potential client, they don't even open these letters, right, because they're so scared, they feel so overwhelmed, when the reality is it's not really that scary, folks. Literally hundreds of thousands of Americans get these notices every year. You're not going to go to jail, right? Okay, yes, interest has accrued. Interest probably isn't as much as you think, especially with interest rates being so low over the past decade or so. Penalties have certainly accrued. Those can be quite large. But the good news is sometimes you can get the penalties abated. Really, the solution all starts with you dealing with the issue, kind of mustering up that courage, looking this issue square in the face, right? Setting aside some time and dealing with this problem by filing your tax returns or hiring a professional like me to help you with this. Not as scary as you think, I promise you. That said, right, if you do want somebody to handle all this for you, reach out to my firm. You can email backtaxes@loganalec.com. You can schedule a free consultation with me and one of my tax managers. I have specific people on my team who specialize in back taxes. We do so affordably as well. We're not necessarily the cheapest, but we're not the most expensive either. All right, so that's the setting we're talking about here. Now, I want to talk about the consequences of not filing your tax returns. First, obvious one, penalties. There are lots of different penalties the IRS can assess. I'll be doing a standalone video on IRS penalties in the future, how to deal with them and potentially abate them. I'm going to be talking about penalties a little bit later in this video as well. But when we're talking about back taxes, the two big penalties you're looking at are failure to file and failure to pay. Okay, between the two, failure to file is the worst one. So just like it sounds, the failure to file penalty is triggered when you don't file your tax return by the due date. Okay, either the original due date of your return or the extended due date if you filed an extension for your tax return. And the amount of failure to file penalty is 5% of your unpaid tax on that return for each month or part of a month that your return is late, not to exceed 25% of your unpaid taxes. So easy math here, right? After 5 months, your failure to file penalty will max out. If your tax return is over 60 days late, the minimum failure to file penalty is a lesser of $435. That number is adjusted every now and then, or 100% of the tax required to be shown in your return. The failure to pay penalty is 0.5% of the tax owed after the due date for each month, or part of a month the tax remains unpaid, up to 25%. If you owe both the failure to pay penalty and the failure to file penalty for a given month, as many people who don't file their taxes do, the failure to file penalty, which is the greater one, gets reduced by the amount of the failure to pay penalty applied in that month. So your maximum combined failure to file and failure to pay penalties for a given month is 5% of the tax due. So doing a little math here, the failure to pay and failure to file penalties max out at 47.5% in month 50. Okay, so that's 4 years and 2 months. So if you haven't filed a tax return that was due over 4 years ago, you're looking at an almost 50% penalty on your tax due. That is substantial. Like I said, I will be releasing a dedicated video on IRS penalties here in the near future, specifics about calculating them, abating them, right? We do this for clients all the time. But for now, let's move on to the second consequence of not filing your tax returns, and that is interest accrual. The IRS charges interest not only on your tax due, but also on your penalties, right? And if your penalty is almost 50% of your tax, that can be a lot. Interest compounds daily on your balance, folks. The interest rate for individuals is the federal short-term rate plus 3%, because right now, as I'm recording, the federal short-term rate is very close to zero. Right now, the IRS interest on underpayments of tax is basically 3%, right? Because the federal short-term rate is adjusted every 3 months. Keep in mind, this could be different in a few months, but it probably won't be that different. So there's the two obvious consequences not filing your tax returns if you owe taxes, penalties, and interest. But what about if you don't owe taxes, right? What if you're owed a refund? Well, aside from the obvious, right, if you're filing late, right, if you're filing your return late to get a refund, then that means the money is just sitting there at the IRS. That could be in your pocket. But aside from that, you could miss out on your refund entirely. Yes, consequence number 3 of not filing your tax return is that you could possibly miss out on your refund, because in order to get a refund from the IRS for a given tax year, you must file the return for that year within 3 years of the due date for that tax return. This is called the refund statute of limitations. After this 3-year window closes, the IRS will neither send you a refund for that tax year nor apply any credits for that tax year, including overpayment to tax for that tax year, to other tax years that are underpaid. So I had someone reach out to me a few weeks ago. She never got around to filing her 2015 return. She said she put it off because she knew she was owed a substantial refund for that year. There are other life situations that happened, right? But she told herself she would get around to it eventually. Well, I had to be the bearer of bad news for her, right? Her 2015 return was due. The original due date, right? Extensions don't count for these purposes. Original due date of her 2015 return was April 15, 2016. So 3 years from April 15, 2016 is April 15, 2019. So she would have had to file her return on or before April 15, 2019 in order to obtain a refund for the 2015 tax year. She was obviously upset by this. This was a significant amount of money for her, but this is just all the more reason to stay on top of your tax return filing obligations. Let me just rattle off some other consequences here of not filing your tax returns. Number 4, inability to get a loan or refinance. Oftentimes when you're getting, a loan, a mortgage, business loan, a refinance, some other kind of loan, in the course of the application, loan officer needs your tax return or your tax returns. And if you don't have them, you're out of luck. Number 5, inability to get student aid, FAFSA, and all that. FAFSA, right, they often want your tax information. Number 6, stimulus and other payments from the government. As we learned during the pandemic, sometimes Congress might pass some aid or assistance for people, and it's based off their tax returns. And if you haven't filed your tax returns, you're potentially off the IRS's radar, and you might be missing out on some money. Number 7, immigration. If you're a permanent resident, you have a green card, and you fail to file a required tax return, you may be considered to have abandoned your permanent resident status in the United States, and you may lose it. Number 8, if you're self-employed, you may lose future Social Security benefits because you won't accumulate any Social Security credits for your self-employment income if your earnings aren't reported within 3 years, 3 months, and 15 days following the end of the year in which you earned the income. There are other consequences, obviously, but number 9 here is a big one as well, and that is if you don't file your tax return, the IRS just might prepare a tax return for you and calculate the tax you owe on their own. If they do that, they'll assess tax, and they could possibly start collection activities like wage garnishment, liens, levies, all that nasty stuff. And it could be you don't actually owe what the IRS thinks you owe, but since you didn't file your return, IRS doesn't know that. So those are some major consequences of not filing your return. Now, kind of piggybacking on that last one, let's talk about the IRS calculating your return and your tax for you. So under Section 6020B of the tax code, the IRS has the authority to prepare its own tax return and process that return when a taxpayer fails to file a required return or files a false or fraudulent return. An IRS prepared return is called a substitute for return, or SFR. And in a second, I'm going to tell you how they prepare these and why they may grossly overstate your tax. But first, I want to mention that the IRS can prepare this return for you, it can process this return for you, and it can assess the tax on you accordingly. Okay? And when the IRS does this, when the IRS assesses the tax based on the SFR, the clock starts ticking on the 10-year statute of limitations for collections that I've talked about in my other tax relief videos. However, the statute for assessment, how long the IRS has to go back to a tax year and assess tax or assess additional tax, that clock does not start running when the IRS prepares an SFR for you. The statute of limitations on assessment never begins if you never file a tax return for a given year. In that case, the IRS can always, indefinitely, go back to a tax year and assess tax or additional tax on it, as opposed to if you file a tax return for a given year, the IRS generally only has 3 years from the later of the due date of the return or the actual filing date of the return to assess tax or additional tax. There are exceptions for some things like fraud, false returns, a substantial understatement of income and things like that. But in general, the IRS has a 3-year statute to assess tax, but that statute only starts running if you actually file your return. It will not start running if the IRS prepares a return for you, a substitute for return. I'll be doing an entire video on IRS statute of limitations in the future, but for now, let's keep on talking about these substitute for returns, these SFRs. First of all, does everybody who doesn't file a tax return have an SFR prepared for them by the IRS? The answer is no. For example, if all you have is W-2 income and you're not significantly under withheld, or maybe you're even over withheld, IRS probably isn't going to file an SFR for you for that year. But if you were unlucky enough for the IRS to prepare a substitute for return for you, then that IRS prepared return is good and sufficient for all legal purposes. And this may not work in your favor. Why? Well, there are many reasons, but here are some major ones. First, the IRS could be using the wrong filing status. On SFRs, the IRS will only use single filing status if you're unmarried and married filing separately if you are married. When in reality, if you're unmarried, maybe head of household would be better for you, right? If you qualify. And if you're married, maybe married filing jointly would be better for you, right? But that's just the beginning of the problems with these SFRs, right? Other things, the IRS may not know about some or all of your dependents. The IRS will only give you the standard deduction. They do not itemize your deductions on an SFR. So even if you have itemized deductions like mortgage interest, charitable contributions, state and local taxes, all that stuff in excess of your standard deduction, the IRS is still just going to use the standard deduction for your filing status on the SFR it prepares for you. Also, if you're self-employed, all the IRS is going to calculate for your self-employment income is your gross receipts reported on 1099. It doesn't know your business expenses, so it's not going to deduct those for you against your gross receipts. Also, for some securities, the IRS doesn't know your basis, right? The IRS, they see the 1099-B with all these proceeds on it. Yeah, it might know your basis for some of your securities that they're covered, but not all of them, right? So it will just give you a zero basis on your SFR. You have to file a tax return to tell the IRS what your basis is in many cases. You have to file a tax return to tell the IRS what your business expenses are if you have a small business. You have to file a tax return to tell the IRS, hey, these are my itemized deductions. So most of the time, this is my point, most of the time the IRS prepared substitute for return is not going to work in your favor and will probably indicate a higher balance due than actually would have been shown if you had filed a tax return. Right? So if you didn't file a tax return and you get a letter in the mail from the IRS saying, hey, we prepared a return for you and you owe this ton of money, you may not actually owe that ton of money, right? Because the IRS may have calculated things not really incorrectly, but they didn't have all the information, right? Whereas if you actually filed your return, you might actually owe a lot less. So this is all to say you should be filing your tax returns. Now let's get practical. How do you tackle this issue of filing your back taxes? Because sometimes there's some strategy involved. Sometimes you may have lost some of your records, right? So what do? Well, you could reach out to a professional. Feel free to email me, backtaxes@loganout.com. You can schedule a free consultation with me and one of my tax managers and get this done. But if you want to do it yourself, let's get practical here. I have some tips for you. Let's say you haven't filed in multiple years, right? Which return should you file first? Well, first of all, let me point out that you might not have to file all years worth of tax returns. In 2006, the IRS put out Policy Statement 5-133, which states that it's generally sufficient to file the past 6 years' worth of tax returns to be considered in compliance in general. They can go longer than that, but they need group manager approval to do so. So I would say if you owe tax returns from longer than 6 years ago, and the IRS hasn't sent you letters looking for them, it might be best to let sleeping dogs lie, okay? Keeping in mind, of course, that if you never file a return for a year, the statute of limitations on assessment never starts to run. But if the IRS is obviously bugging you to file an old return, or has done an SFR for you and assessed tax based on that SFR, and the SFR really overstates your tax liability, you may want to file for that year, even if it's outside the 6-year window. So step one is figure out what years you should file for. Then when you have that population of tax years, right, next step, especially if you're doing this shortly before April 15th of a given year, is to think about the tax year whose refund statute of limitations expires this coming April 15th. So for example, let's say you're sitting down to think through all this in late March, early April 2022, right? So what's 3 years before April 15th, 2022? 3 years before April 15th, 2022 is April 15th, 2019. What tax return was due without regard to extensions on April 15th, 2019? The 2018 tax return. So in this case, I would say you might want to work through your 2018 return first. Don't necessarily file it, but just work through it first in your tax software to see if you're owed a refund for that year. If you are owed a refund for that year, you really want to prioritize getting that 2018 return done and filing that 2018 return before the refund statute expires on April 15, 2022. Okay, it might actually be different than that if April 15th fell on a weekend or holiday or something like that. I haven't gone back and checked the calendar on that, but that's the general thought process here, right? And obviously, if you're coming up against a current year tax filing deadline, you might want to prioritize the current year as well. But in general, you do want to go in order, okay, starting with the oldest year first. Why? Because sometimes tax items carry forward from one year to the next. For example, let's say you sold some stocks for a $10,000 loss in 2017, and you had no other capital gains or losses that year. Well, you could deduct $3,000 of those losses on your 2017 tax return, but then the remaining $7,000 would be carried forward to future years, right, like 2018. So if you jump right into your 2018 return without having first prepared your 2017 return, or at least been cognizant of the issues and potential carry forward issues arising in 2017, you may prepare your 2018 return without taking into account, for example, the capital loss carry forward from 2017. That's just one example, right? So in general, due to these carry forwards, I generally like to start with the oldest year first and go sequentially. There are many other carry forwards than just capital loss carry forwards. There are charitable contribution carry forwards. There's home office expense deduction carry forwards. There's net operating loss carry forwards. There's passive activity loss carry forwards, right? Especially those of you with rental properties, so on and so forth. So by this point, you should have a game plan in mind of what returns you're going to tackle first, right? And then comes the process of actually preparing these returns in your tax software. Now, if you have all the tax documents for a given tax year, that's great, right? Bravo. But I would say you should still get your transcript for the years you have to file from the IRS. Okay, how do you get your transcript? I'll probably create a whole other video on this because that's a topic in and of itself. But in a nutshell, pretty easy to do. You can do it online, as a matter of fact, up to a certain number of years at irs.gov/individuals/get-transcript. The reason I say this is because you really want to know what the IRS is working with here. You want to make sure that you're seeing what they're seeing, right? And when you look at the transcript, you'll see, all the 1099s that were filed with the IRS for you for that year, your W-2s, your K-1s, 1099s, 1099Bs, right? All the tax documents the IRS see for you for that tax year, because it's possible you may not have received one, or maybe got lost over the years, right? So that's a good place to start, the IRS transcript. Also, when you pull your transcripts, you should be able to see if the IRS has prepared an SFR for you. If it has, and the amount of the SFR is actually a lot less than what you actually owe, which is rare, but it does happen, then you kind of have a little ethical dilemma here, right? Should you file your return even though the IRS says you owe less? I'm not going to speak to this in this video. If you're in this situation, feel free to reach out to me, backtaxes@loganalec.com. We can work through that. All right, so check your transcripts, see what the IRS is saying on an SFR, if there is one. That should pretty much cover your bases as far as third-party prepared tax forms like 1099s and W-2s go. But what about items of income or expense that are not reported on 1099 and W-2? What about if you're self-employed? You have a business, you collect small payments from your customers who are just consumer customers. They don't send you a 1099. IRS doesn't know how much you had in receipts. They obviously don't know your expenses until you tell them. But what if you don't know what your income and expenses were, right, for that tax year 3, 4, 5 years ago? Well, You have to get a little creative. You have to estimate. But in the business, we don't say estimate because that kind of sounds like a guess. We say reconstruct. We reconstructed a taxpayer's income and expenses for the year using credible evidence. How do we do this? Well, we got to pull from sources, right? Third-party sources. We pull the bank statements, right? That's an obvious place to start. From there, we look at other third-party information, right? Property taxes, you can look those up online. DMV fees, you can look those up online. Medical expenses, we can generally go to the provider, possibly the insurance company, request records. If you don't know your state withholdings, you can check the State Department of Revenue, request from your employer. Obviously, you'd want to pull brokerage statements, right, to make sure what's on the IRS transcript is correct, okay? Sometimes they do leave out basis even when it's reported to them. Also, I've had clients where they acquired stock so long ago and they transferred the stock, from one brokerage to another over the years. They don't remember exactly how that all happened. We didn't have records of the basis, right? No one had the records. Maybe somebody did, but we didn't know who they were. So we had to go back and look at, hey, what was the closing stock price by date? So in this reconstruction of records, there's a lot to think through, and especially for those of you with the business, right? Because your situation is just more complicated than others. So there's some additional resources here to help you business owners out there. One is the IRS Audit Technique Guide for your particular industry. I'll put a link in the description below to the IRS Audit Technique Guides page. Basically what these are guides the IRS has published to help its own auditors audit certain types of businesses. Because IRS auditors, they look at so many different kinds of businesses, they don't necessarily know what's reasonable in terms of P&L for each specific kind of business, right? And the IRS has these for a few industries. For example, here's the one for car washes, right? And you can see what the IRS thinks through when it comes to auditing car washes. It has information on what its auditors should look at when examining income, for example, from self-serve activities where the customers clean and vacuum their own car, right? Under consumption methods, for example, they have various methods of reconstructing the car wash's income based on the amount of water, soap, or chemicals consumed, right? Like, for example, they can look at the water bills, right? And they can get those from a third party, the city or the municipal water authority or whatever. And then they have this formula, right, that they might use to determine the taxpayer's gross receipts during the year based on their water usage. And they'll compare that to what the taxpayer report as a gross receipts and say, you used way more water, right? Based on the amount of water you used, we think that you actually had more receipts, right, than what you report in your tax return. Audit Technique Guide. So, right, if you own a car wash and you have no idea what your receipts were for the year you didn't file in and you don't have the records, and a lot of customers paid you in cash they didn't always deposit, right? Because the cash intensive businesses, the IRS knows the tricks, right? But if you can get access to your water bill, which your water company, right, it has, then maybe you can kind of back into your receipts, looking at the IRS formula here. And at the IRS questions, you can say, hey, I just did what you say to do in your Audit Technique Guide, right? So that's just one example. Check out the Audit Technique Guides. A link to that page on the IRS website is in the description below. Some more resources for your business owners out there as you reconstruct your records are bizminer.com and bizstats.com. These sites basically give industry averages for various expenses. In fact, there was a tax court memorandum decision, David W. Bauer versus the Commissioner of Internal Revenue. By the way, in tax court cases, generally the IRS as respondent is simply named as the Commissioner of Internal Revenue rather than IRS. Anyway, in this case, the tax court held that the taxpayer here, David Bauer was his name, could, and I quote, deduct an estimated amount of contract labor expenses for each tax year at issue using the 2006 average ratio found in the BizMiner report. So especially if you're a business owner and you have no idea whatsoever where to start, might be a good idea, right, for you to check out the industries the IRS does have audit technique guides for, and consult the one for your industry, right, if there is one for your industry, as well as check out sites like bizminer.com and bizstats.com. Now, one thing to keep in mind as you're preparing old returns, and your tax software will obviously handle this for you, but keep in mind you have to use the tax laws that were in place for that tax year. Just because you're preparing the return now doesn't mean you apply the current tax laws, right, to that older year, 2018 or 2016 or whatever. You apply the tax laws that were in place at the time of that tax year. Okay. All right. So those are some pointers on preparing your back tax returns. Now let's talk about actually filing them. First of all, can you e-file them? Well, the current year taxes that are due, you can obviously e-file, right? But you can also e-file the preceding 2 tax years, right? At least professional tax softwares can e-file the preceding 2 tax years. That's a general protocol. Okay, I don't know about all the retail tax softwares, but at least if you work with a professional, we can definitely e-file, obviously the current year as well as the 2 preceding tax years. Now, what about tax years older than 2 years? Those returns you'll have to mail in. My recommendation is when mailing in returns to the IRS that you don't use regular mail. It's better to use maybe USPS return receipt requested or even a private delivery service. I would also not recommend just putting all your paper filed returns in one envelope, right? And that's it. You can send them separately, like in separate envelopes, which might be best, or you can put each return each in its own envelope and then put all those separate envelopes into one main envelope and mail that. But whatever you do, don't just put all your returns in one envelope, unseparated. Okay, why? Well, years ago, I had prepared a client's, I think it was 2008 through 2010 returns, which were past due. I sent it to the client for the client to sign the returns and mail off. Client did that, right? She did that perfectly. Some time went by, right? I had a power of attorney for the client. So I called the IRS and said, hey, I'm Logan Alec. I'm representing so-and-so. I just want to make sure that you've received her 2008, 2009, and 2010 returns and that they're in processing. Person at the IRS said, yes, Mr. Alec, we see that we have received her 2008 tax return, but we don't see that we have received her 2009 or 2010. I'm sorry. I called the client, told her what the IRS said. I asked my client, are you sure you mailed them all? Right? It's weird the IRS received 2008, but not 2009 or 2010. Client said, oh yeah, I signed them all. I put them all in the envelope and mailed them off. Well, come to find out what happened is apparently in marking off which returns had been submitted, the person at the IRS who was in charge of that day at that processing center, they just looked at the first page of the stack of papers the IRS received. They saw 2008, right, U.S. individual income tax return. They must have only indicated that 2008 had been received. They didn't flip through the other pages to look for the other tax years. So to prevent that from happening, that's why I recommend, right, if you don't want to send the separate tax years in separate mailings to the IRS with separate postage and all that, right, at the very least, at least put the returns in separate envelopes, one return for each envelope, and then you can mail all those separate envelopes in one large envelope. So that's one practical consideration to make when filing back tax returns older than 3 years. All right, so at this point, you file your back taxes. Right now, as I close out this video, I just want to talk a little bit about penalty abatement. I will be releasing a video all about getting rid of IRS penalties in the future, but for now, I just want to go over some basics. The two main types of penalty abatement we pursue with back taxes are first-time abatement and abatement for reasonable cause. There's also a statutory exception, but that's relatively rare. You have to show that the IRS provided you with erroneous advice for that one, okay? Like I said, I'm going to go more in depth on penalties in a future video, but let me just go over these two kinds of penalties. Basically, first-time abatement is kind of a gimme penalty abatement. You can use it to abate the failure to file, failure to pay, and failure to deposit penalties. The thinking here is that everyone deserves a second chance, right? Basically, how first-time penalty abatement works is it will generally only apply to the first year of the back taxes you have to file, okay? And you have to be in compliance. So this is generally something we look at after we filed for the client and gotten them in some sort of compliance with the IRS. And you can only get first-time penalty abatement on one tax year, and generally the oldest tax year at issue. There are some other tax rules having to do with this kind of penalty abatement that I will get into in my dedicated penalty video, but let's leave it at this for now. The other kind of penalty relief you'll generally see with back taxes is relief for reasonable cause. And as it sounds, to get this kind of relief, you need to give the IRS some sort of reasonable cause why you weren't able to file and pay your taxes on time. And, when writing your reasonable cause statement, you really need to pull all the strings, right? For example, I know this might sound offensive to some people, and I apologize for this in advance, but if you're age 65 or older, say you're elderly or have your representative refer to you as elderly. I would never in an everyday conversation refer to a 65-year-old as elderly, but it sure sounds good in my letter to the IRS to say the elderly taxpayer was not able to file their 20 whatever and 20 whatever tax returns timely due to blah, 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 right? Just think about your language or diction. Look for little turns of phrase like that. Because with these penalty abatements, there are real people at the IRS reading these things and making determinations based on their judgment. So like I said, I do plan on having more content specifically about getting rid of IRS penalties, but I'm going to leave this video here at this point for now. We've already been doing this for about half an hour. Like I said, if you want professional assistance with your back taxes, making sure they're filed correctly and strategically, reach out to me, backtaxes@loganalec.com. We'll have a chat. Also, it's often the case that after we prepare a taxpayer's back tax returns, it turns out they owe a lot of money to the IRS. One of the most powerful tools in our tool belt as tax professionals to get rid of the tax debt is the offer in compromise. I recently created a dedicated video that takes you through exactly how to calculate your own offer in compromise. That video is right over here. I also have another tax relief video for you right down here. Thank you so much for watching, everybody. I'll see you in those videos. Don't hesitate to reach out if you need back taxes filed. Bye-bye.